In our last episode, we analyzed why the traditional SIP model has plateaued, failing to deliver real alpha for the Indian professional over last 3 fiscal years. And today, we will find out what happens if you do not see green in your portfolios for long. When the SIP fails to move the needle, most professionals between 25 and 45 pivot to active management. This is the transition from set and forget mutual funds to taking the wheel. Today we evaluate why this shift from passive saving to active hunting has become a high stress trap that erodes both capital and cognitive bandwidth in 2026. Let's look at the hard data as of April 2026. The latest SEBI longitudinal study confirms a grim reality. 91% of retail participants in the F&O segment are net negative. Despite the influx of FinInfluencer education, the loss ratio has not budged because the market structure has evolved. In the last 18 months, the Nifty has experienced 4 distinct 1,000 point drawdowns. These were not caused by domestic earnings but by external shocks, specifically the US-Iran maritime tensions and the resulting spike in Brent crude. For an import-dependent economy like India, these spikes lead to immediate rupee depreciation and FII outflows. If you are practicing active management without a desk-level understanding of macro hedging, you are not investing. You are providing liquidity to institutional algorithms that trade in microseconds. The active approach is fundamentally broken for 3 systemic reasons. First, the misalignment of leverage. Retail traders often use F&O to compensate for a small capital base. However, in 2026, market is defined by sudden extreme moves. Leverage acts as an accelerant for ruin. A 2% gap down at the Monday open can wipe out a month's salary before you finish your first stand-up meeting at work. The second one is the death of goal-based allocation. We are seeing a dangerous trend where surplus savings are being commingled with high-risk bets. When you mix your child's education corpus with a speculative position in a mid-cap tech stock, your risk tolerance is not driven by maths, it's driven by fear. This leads to loss aversion bias, where you hold on to losing trades hoping for a break-even that never come. And the third one is the cognitive drain. For a professional in Bangalore or Mumbai, your primary asset is your career alpha, your ability to solve complex problems and earn. Active management of stocks requires constant monitoring of the volatility, the global news cycles and local news cycles. If you are checking your P&L 6 times in an hour, you are not just losing money, you are degrading the professional performance that actually funds your investments. You are trading a high certainty career path for a low profitability market bet. The hidden cost here is revenge trading. After a significant drawdown, the human brain seeks to recoup losses through increased position sizing. In the 2026 volatility clusters, this is a death spiral. We have seen portfolios that took 5 years to build vanish in 2 weeks of emotional decision making. So consider the smart money lens. Institutions love retail volatility because it creates forced liquidations. When you panic sell your quality mid-cap during an oil price scare, you are selling to someone with a 10-year horizon and $1 billion hedge. You are playing a game where the house has faster data and cooler nerves. For the 25 to 45 demographic, this constant state of alertness leads to burnouts, which is far more expensive liability than a 10% portfolio dip. As we conclude, understanding that choosing active management over passive SIPs has become suboptimal use of both time and capital for most. It is an attempt to solve systemic wealth problem with high-octane gambling. So let's do a quick recap and see how far along are we on this journey. In episode 1, we saw how the set and forget SIP model stopped beating inflation in 2026. Today, in episode 2, we have analyzed why jumping into the driver's seat through active trading often leads to stress trap, where leverage, emotional mixing of funds, and the drain on your professional focus actually sets you further back. So we are seeing a pattern. The traditional routes to wealth for the Indian professional are narrowing. And in our next episode, we'll analyze the third pillar of the Indian dream, real estate. We will look at why property has become the capital trap of 2026. Extremely illiquid, burdened by high maintenance costs, and increasingly out of reach for even high earning professionals in Tier 1 cities. So if you prefer data over hype, subscribe and join our community of methodical investors. And also drop a comment below if you would like to engage. Have you ever calculated the hourly rate of your active trading? And was the profit worth the time spent? So thank you for tuning into this episode, and thank you for your time.